Hi everyone, it's Jab on another video. Today I'm going to be talking about Mattel, which has obviously seen a lot of publicity recently with the phenomenon that is the Barbie movie and potential for a Barbie universe going forward, and that has led to a lot of hyperbolic news articles like this one you see from relatively reputable sources like the BBC. Can Barbie be the new Iron Man in a Mattel universe? Seen lots of articles like this talking about potential for a Mattel universe akin to the Marvel universe or akin to Disney's strategy basically. That very obviously is Mattel's strategy to become an IP and toy business rather than just a toy business. There is some weight behind this. Google trends for the Barbie doll and associated phrases are above even Black Friday levels. Obviously loads of potential. They have lots of new IP going forward that has major names attached. Tom Hanks attached to one of the projects. So let's analyse this business, have a look at its brands, have a look at its recent performance, its most recent performance from a quarterly results basis, and analyse what we think of this business going forward and whether it can become, a baby Disney, this type of live up to these expectations. So let's get into it. Here is a graphic showing the catalogue of brands for this business, and I don't think that statement of one of the strongest catalogues of children's and family entertainment franchise in the world is untrue. I think there's definitely some major brands here. Not all of these household names by any means, but the likes of Uno, Barbie of course, Bob the Builder, Hot Wheels, Barney, Fisher-Price, Thomas and Friends, Kaplunk even. There's lots and lots of brands here. Not necessarily ones that I think you could create MCU-like cinema universe from. However, there's definitely a lot of brands here that I think could make a sizable IP catalogue to boost this business's revenue going forward. And this pivot towards the business also becoming an IP licensing business as well as a toy maker is basically because the performance of this business over the long term has been pretty poor. While this year, or year to date, it's around 21% better than the S&P 500, that is absolutely admirable performance, but over the medium term it's been a poor investment. The last 5 years it's up 43% with no appreciable dividend. That's losing to the S&P 500, and over the much longer term it has generally been a poor investment. While the stock performance over the last 10 years hasn't been absolutely horrendous, the business performance in terms of revenue has, in my opinion. Trailing 12-month revenue at the end of 2013 was almost $6.5 billion. Right now it's just over 5.2 billion. That's thoroughly unimpressive. That business is going in a backwards direction, and while there was a clear trough and the business has recovered significantly since its 2018 to 2020 lows where it was in the $4 to $4.5 billion range, this is frankly not good enough, and this is why there is such a need for this business to become an IP licensing business as well as a toy manufacturer, because the toy manufacturing is just not working. I'm really quite impressed with Mattel's management and how they're planning to grow their IP-driven toy business going forward and expand their entertainment offering. Clearly, they want to accelerate the top line, as most businesses do, by scaling the portfolio, growing franchise brands, and advancing e-commerce and direct-to-consumer, which between the three of them don't mean a whole lot, but advancing e-commerce and direct-to-consumer is obviously a key thing to do. To increase margins by going direct to consumer is fairly obvious in my opinion. That will help increase in profitability, also optimising operations. The key one here is what they should have been doing all along really in my opinion, and that is capturing the full value of IP as companies like Disney do, expanding content, consumer products and digital experience, and this really is the key in my opinion because it already has a great family of brands. This is the key growth pipeline for this business. This is the only way I can see it rapidly growing. With the toy business, I can see maybe growing in the high single digits a year at best, and that's really best case scenario. The entertainment business is really the growth driver for this business going forward, and it's the whole investment thesis in my opinion. While strategically management really impressed me on their plan going forward, their actual operating results, and particularly the management of retail inventory levels, has been extremely poor in my opinion. Net sales $850 million quarterly on a constant currency basis, that's down 21% year over year. Very, very poor results in my opinion. Adjusted gross margin just 40%, that's down 660 basis points. Meant the business swung to an operating income loss, and quite a considerable one, and adjusted earnings per share has gone to around minus 32 cents a share, which is very, very unimpressive in my opinion. They expect consumer demand to be positive for the full year, of course, with the backing of Barbie going forward, just around $1 billion of this business's sales, and revenue comparisons to improve as shipping patterns revert to their historical trends. I think this is really old jargon. This is a very, very poor quarter in my opinion. I don't think guidance going forward is absolutely excellent that can make up for this. This business is already fully priced in my opinion, and these results are very, very poor. Of course, while there is outside pressures that have to be considered, 2022 was also a relatively tough year, and the business has definitely gotten worse in terms of operations and in terms of pretty much every cash flow metric. This business is a worse business. Net income, they swung to a loss. Previously they were $21 million in profit the previous year, now $106 million loss. Negative free cash flow of nearly $250 million. That is previously negative of $180. This business is eating cash, and I do not believe, as they say at the bottom, the strong financial position. This business does not have a particularly strong financial position, and I think repurchasing shares is absolutely the wrong thing to do. Then the current share price has been much lower, around $15. Current share price is actually doing reasonably well. There's been many better times to buy back shares in this company's history when it hasn't. I don't think this is a very good time to be buying back shares. I think there's a lot of capex to be done, a lot of cash flow to be put back into this business. I think when your free cash flow is negative $250 million for the quarter, you should not be buying back shares. As I mentioned briefly, the guidance for the business is not particularly strong. They did reiterate it, so they're expecting net sales to be comparable with 2022, so essentially flat year over year, looking around $5.5 billion, $5.4 billion, there or thereabouts. They expect retailers to continue to manage their inventory, and second half shipments are going to revert to historical trends, but this half of the year is going to be weak. Adjusted gross margin, they're expecting around 47%, which is slightly higher than last year, which got to give them the flowers for that. But they've got a long way to go when the current gross margin for the most recent quarter was just 40%. Earnings per share, they're expecting in the 1 to 120 range. That's going to mean this business is fully priced in my opinion, probably going to be looking around 15, 16 times earnings. Adjusted EBITDA, just shy of $1 billion, and free cash flow to be in the $400 million range. Again, we're going to have to see a very, very impressive jump in the second half of the year. I'm not sure they can actually hit these guidances. So really I've presented that this business is performing poorly recently, but as Barbie movie coming out and there's a lot of potential going forward, it does make it a staggering investment opportunity, but it could be a good investment opportunity at the right price, managing the risk. And right now I think the price is a little frothy. Judging by those earnings guidance that they've given, we're looking around a forward guidance around 16 times earnings. That's lower than its 5-year averages, but its 5-year averages are grossly overvalued in my opinion. I think the time to buy this stock really was 2022 when it's trading at less than 10 times forward earnings. PEG ratio of 0.78, PEG ratio of 1.36 indicates decent price, possibly fairly valued, not a bargain by any means. Current price to earnings obviously grows nearly 30 times. Price for cash flow 20, again far above S&P 500 averages, not particularly impressive. That price forward earnings is roughly in line with the S&P 500. Obviously risk adjusted you would buy the S&P 500 because that is a relatively riskless compared to this. However, Mattel definitely has some potential. I'm just not sure if right now is the right price to be buying it. I think many people have looked at the Barbie film coming out and looked at the potential for an unlocking of an IP catalogue and thought this business is lowly valued at 10 to 12 times earnings. Now looking at 16 times forward earnings, I think that's fully priced in. I think there's a lot of execution risk for management here. Don't think Barbie's going to save them by any means. That could unlock a lot of revenue this year, next year. Is it going to make them a lot of revenue in 5 years? Who knows? Significant execution risk for a business that is not executing very well in my opinion. Of course, they have a strong catalogue of franchises and brands, which I hope they'll be able to unlock via IP. And license them out or create more entertainment franchises. They have a couple of films that are in the works. Tom Hanks is attached to one of them. Maybe they can generate the same success as Barbie, but it's important to remember that Barbie really is the crown jewel of this business. So of course that is going to be the best performing one. And even if it does a bit over $1 billion in revenue or over $1.5 billion in the box office, which is probably expected to do, I don't think this is going to save this business anytime soon. It does not make it a compelling investment in its own right. For me, at 16 times earnings, it's just a little overvalued. I'd be much happier paying for around 12 times earnings. So what's call that? Probably the 52-week low is around $15, $16. I'd have been much happier investing in this business. Right now, I'm happy to leave it and call it one. I'm on the watch list. I'm not going to be buying it anytime soon. With that being said, of course, this is just my opinion. I'm not a financial advisor, so you should not take any of this as financial advice. You should do your own research and due diligence. It's capital at risk, of course, when buying any stock like this. Or speak to a financial advisor. Or let me know in the comments down below what you think of Mattel. If you think Barbie's going to be the absolute saviour for this business, whatever you think, let me know in the comments down below. I'll see you next time.